Before we begin, it's crucial to understand that the information in this video is for educational and informational purposes only. Trading foreign exchange on margin carries a high level of risk and may not be suitable for all investors. The high degree of leverage can work against you as well as for you. Before deciding to trade foreign exchange, you should carefully consider your investment objectives, level of experience, and risk appetite. The possibility exists that you could sustain a loss of some or all of your initial investment, and therefore you should not invest money that you cannot afford to lose. This presentation is not financial advice. Please consult with a licensed financial professional before making any investment decisions. Let me ask you a question. What do you think is the single biggest reason over 90% of new Forex traders in the United States blow up their accounts and walk away forever? Is it a bad strategy? Is it the brokers? Is it the algorithm hunting their stop losses? No, it's none of those things. The real reason is that most new traders are trying to fly a Boeing 747 after reading the little safety pamphlet in the seatback pocket. They have a surface-level idea of what to do, but they have absolutely no idea how the machine actually works. They don't understand the physics of flight, the engineering, the weather patterns. They just know that you pull back on the yoke to go up. And for a little while, that might even work. You might get off the ground. You might feel the thrill of climbing. But when the first storm hits, when the turbulence starts, when the instrument panel flashes a warning light you've never seen before, they panic. They overcorrect. They crash and burn. I know this because I've been there. I remember my first live account. It was a couple $100, which felt like $1 million to me at the time. I had my chart set up with about 15 different indicators. My screen looked like a Christmas tree, and I felt like I was on the cutting edge. I'd watched 100 YouTube videos, I was in a dozen Discord channels, and I thought I had it all figured out. My first trade was a winner. Pure luck, but my brain told me it was pure genius. The dopamine hit was incredible. I thought, this is it. This is the path. I'm going to be one of the success stories. And then came the next trade. And the one after that. I started revenge trading. I widened my stops, then I got rid of them completely. I broke every single rule I had set for myself, because in the heat of the moment, my emotions completely hijacked my brain. Within a week, my account was gone. And the worst part wasn't the lost money. It was the feeling of being a complete and utter fool. It was the crushing realization that I didn't have a clue what I was doing. This is the story of almost every trader. You get into Forex because you see the potential for financial freedom, for a different kind of life. You see the posts on Instagram, the guys with the laptops on the beach. You want a piece of that. So you dive in. You open up YouTube and you're hit with a tidal wave of information. This one indicator guarantees 98% wins. The secret broker strategy they don't want you to know. Copy my trades and make a fortune. It's a war for your attention, and everyone is screaming. You have so-called gurus telling you to buy their $1,000 course, signal providers promising easy profits, and algorithms that claim to have solved the market. It is an overwhelming, confusing, and incredibly dangerous environment for a new trader. You're trying to learn a complex professional skill, but you're learning it in the middle of a casino during a hurricane with 100 different people shouting bad advice in your ear. It's a recipe for disaster. And for us here in the United States, it's even more complex. We navigate a different regulatory landscape. We have to deal with the FIFO rule, pattern day trader classifications, and finding NFA-regulated brokers we can trust. The advice that works for a trader in Europe or Asia might not even apply to us. So we're not just learning to trade, we're learning to trade within a very specific and often restrictive system. It adds another layer of complexity that can feel absolutely crushing when you're just starting out. So what's the answer? How do you cut through all that noise? How do you build a real, lasting foundation of knowledge that can actually serve you for a career in trading, not just for a few lucky guesses? The answer is so simple, so old-fashioned that most people completely ignore it. It's books. I'm not talking about a 20-page PDF ebook someone is using as a lead magnet. I'm talking about real, physical, time-tested books written by people who have actually mastered this craft. The market is a vast, deep ocean, and a YouTube video might show you a pretty snapshot of the surface. But a good book gives you the submarine. It takes you down into the depths. It shows you the currents, the topography, the hidden ecosystems. It teaches you how to navigate, not just how to float. Think about it. Every other serious profession on the planet requires a deep, structured education. Doctors go to medical school. Lawyers go to law school. Pilots spend thousands of hours in simulators and training. Yet, for some reason, people think they can become a master of the largest, most competitive financial market in the world by watching a few playlists on the internet. It's insane. The greatest traders of our time, Paul Tudor Jones, Ray Dalio, Jesse Livermore, they weren't just gamblers. They were obsessive students of the market. They were readers. They built their success on a bedrock of core principles, not on some flashy new indicator. In this video, I'm going to give you the key. I'm going to give you the curriculum that I wish someone had given me on day one. This isn't just a list of my favorite books. This is a strategic, curated library designed specifically for the new American Forex trader. This is your flight school. This is your medical school. We are going to build your trading career from the ground up the right way with the right tools. We're going to cover the 3 essential pillars of trading success. First, and most importantly, we're going to tackle your mind, the psychology, because I can give you the most profitable trading system in the world, but if your head isn't right, you will find a way to lose money with it. You are your own biggest enemy in the market, and we are going to arm you for that internal battle. Second, we'll dive into the mechanics, the actual strategies and technical analysis, but we're not going to learn 100 different patterns. We're going to focus on the timeless principles of price action, market structure, and understanding what the chart is actually telling you. This isn't about memorizing candlestick names. It's about learning to read the story of the market. And third, we're going to cover the one thing that separates the professionals from the amateurs: risk management. This is the least sexy part of trading, and it's the most important. It's what keeps you in the game long enough to become profitable. It's your defense, and in trading, a good defense is what ultimately lets you win. Each book we discuss is a piece of this puzzle. One is your psychological coach. Another is your strategy mentor. Another is your chief risk officer. Together, they form a complete education. Following this path has the potential to save you thousands of dollars in blown accounts, and more importantly, years of wasted time and frustration. This is your chance to get off the hamster wheel of searching for the next holy grail and start building a real professional-grade skill set. This is your path to becoming part of the 10% who survive and thrive. The first book on our list is, in my opinion, the single most important book any trader will ever read. It has nothing to do with charts, indicators, or entry signals, but it has everything to do with whether you will succeed or fail. It's the book that addresses the 747 pilot, not the plane. It addresses the surgeon, not the scalpel. It focuses on the one variable that you and only you can control: yourself. And the book that does this, the one that has been called the absolute Bible of trading psychology, is Trading in the Zone by Mark Douglas. Now, I want you to pause and really think about that title. Trading in the Zone. It's not called Analyzing in the Zone or Predicting in the Zone. It's about a state of mind, a state of effortless execution where you are so in tune with your strategy and yourself that the emotional highs and lows of the market simply wash over you. Does this sound familiar? You spend an entire weekend backtesting a new strategy on the euro to US dollar. The results look incredible. You're excited. Monday morning comes, the New York session opens, and you see the perfect setup. You enter the trade, your heart pounding. The price moves a few pips in your favor, you feel like a genius. Then it reverses. It's heading for your stop loss. Panic sets in. You think, maybe I should move my stop just a little further down? The analysis was solid, it has to turn around. You move it. Price blows right through it. Now you're in a bigger hole than you planned. You feel that hot sting of frustration. You close the trade for a massive loss. A few minutes later, another setup appears. You hesitate. What if I lose again? You wonder. That's the fear talking. Or maybe you get angry. You see another setup and think, I'm going to make my money back on this one. You double your position size. That's revenge trading. This emotional roller coaster is the #1 reason why traders with perfectly good strategies fail. They haven't mastered their own mind. This is the problem Mark Douglas tackles head-on. He argues that most of us are hardwired with beliefs about winning, losing, and uncertainty that are completely counterproductive in the trading arena. In our everyday lives, we're taught that more effort equals better results, that being right is good, and that uncertainty is something to be feared and avoided. In the markets, those beliefs will destroy you. Douglas introduces what he calls the 5 fundamental truths about trading. Internalizing these isn't just a suggestion. It's the foundation for building a professional trading mindset. The first truth: anything can happen. Anything. A central bank can make a surprise announcement. A geopolitical event can happen overnight. A massive institutional order can hit the market and move the price against your perfect, set up for no reason you can see on your chart. You have to accept down to your core that you don't know what's going to happen next. There are no certainties. The second truth: you don't need to know what's going to happen next to make money. This sounds like a contradiction of the first, but it's not. This is the key. You don't need a crystal ball. You just need an edge, a strategy that, over a large number of trades, has a higher probability of winning than losing. Think of a casino. The casino doesn't know if you're going to win or lose the next hand of blackjack. They don't care. They know that over thousands of hands, their small statistical edge will play out, and they will be profitable. Your job is to be the casino, not the gambler hoping to get lucky on one hand. This leads directly to the third truth. There is a random distribution between wins and losses for any given set of variables that define an edge. This is a huge one. Let's say your strategy wins 60% of the time. You could have a sequence of 4 losses in a row, followed by 6 wins. Or you could have a win, then a loss, a win, then a loss. The distribution is random. If you try to guess which trade will be the winner and which will be the loser, you'll drive yourself crazy. You'll start skipping trades after a few losses out of fear, only to see them become massive winners. Or you'll get overconfident after a few wins and take a sloppy trade, leading to a big loss. You have to execute your edge flawlessly on every single setup, regardless of what happened on the last trade. The fourth truth: an edge is nothing more than an indication of a higher probability of one thing happening over another. Your fancy indicator, your trendline break, your candlestick pattern, none of them guarantee anything. They are simply tools that, when used correctly, suggest that the price is more likely to go up than down or vice versa. That's it. When you see your setup, you're not seeing a promise of a winning trade. You are seeing a higher probability scenario that you, as the casino, are supposed to take advantage of. And the fifth and final truth: every moment in the market is unique. Just because a setup looks exactly like one that made you a lot of money last week doesn't mean this one will do the same. Each moment is a fresh combination of all the traders in the world with their own beliefs and agendas. This truth liberates you from the burden of the past. The last trade doesn't matter. The only thing that matters is this moment, this setup, and your ability to execute your plan without hesitation or emotion. When you truly absorb these 5 truths, it changes everything. You stop thinking of trades in terms of right or wrong. A losing trade isn't wrong if you followed your plan. It's just a necessary business expense, part of the random distribution. A winning trade doesn't make you a genius. It's just your edge playing out. You detach your ego from the outcome of any single trade. Douglas's core message is to cultivate a probabilistic mindset. You stop being a predictor and start being a professional who executes a proven edge over and over again. You define your risk before you enter every single trade. You know exactly how much you stand to lose, you accept that risk completely, and then you let the market do what it's going to do. This book is not about chart patterns or economic indicators. It's a manual for rewiring your brain. It teaches you how to think like a professional trader. It's the book you read, and then reread every 6 months, because you'll pick up something new each time as you gain more experience. It's the book that will save you from yourself. Because in the Forex market, the greatest risk isn't the dollar yen or the British pound. The greatest risk is the person staring back at you in the mirror. So, we've now established the absolute necessity of mastering your internal world. With a rock-solid psychological foundation built on the principles from trading in the zone, you're no longer your own worst enemy. You're ready to execute. But execute what? You've controlled the pilot, but now you need to understand the weather patterns, the air traffic, the very physics of flight. You need to understand how the market itself truly behaves. Forget the lagging indicators and the confusing systems for a moment. What if you could learn to read the raw language of the market itself? The next book on our list does exactly that. It peels back the layers of complexity and reveals the simple, powerful, and repeatable patterns that drive price movement every single day. It's the book that teaches you to read the story that the chart is telling you, moment by moment. But here's the billion-dollar question. Once you can read that story, what do you do with it? What happens when the story takes a plot twist you didn't expect? What happens when you read the story perfectly, place your trade, and it still goes against you? This is the moment where 90% of aspiring traders fail. It's not because they can't read the charts. It's because they can't read themselves. And that brings us to the single most important book you will ever read on your trading journey. A book that has nothing to do with candlestick patterns, indicators, or economic news. It has everything to do with the 6 inches between your ears. I'm talking about Trading in the Zone by Mark Douglas. If the last book we discussed is your technical playbook, this book is your mental constitution. It's the operating system for your brain that allows you to execute that playbook flawlessly, without fear, without hesitation, and without self-sabotage. Mark Douglas, a legendary trading coach, starts with a brutal truth. Most of us are psychologically hardwired to be terrible traders. Our brains, designed for survival in the physical world, are a liability in the world of markets. We are wired to seek certainty, to avoid pain, and to see patterns where none exist. In trading, these instincts are a recipe for disaster. Think about it. You've spent weeks learning a solid strategy. You see a perfect A+ setup on the euro to US dollar chart. Checks all your boxes. You place the trade. And almost immediately, it moves against you and hits your stop loss. What's your first emotional reaction? Is it anger? Frustration? Do you feel like the market is personally out to get you? Do you immediately start questioning your strategy, thinking, I knew it, this stuff doesn't work? If you felt any of this, you're not alone. This is the default human response. And it's this response that leads to revenge trading, doubling down on losing positions, and ultimately blowing up accounts. Trading in the zone is the antidote. It systematically dismantles this flawed, emotional thinking and replaces it with a probabilistic mindset. This is the core of the entire book. Douglas argues that professional traders aren't better predictors. They are simply better at accepting uncertainty. They think in probabilities just like a Las Vegas casino. A casino doesn't know if the next spin on the roulette will be red or black. They don't care. They know that over thousands of spins, their small statistical edge, those green 0 and double 0 slots, will yield a predictable profit. They operate from a belief system that accepts randomness on a trade-by-trade or spin-by-spin basis, but trusts their edge over the long run. Douglas teaches you how to become the casino, not the gambler pulling the lever. He does this by introducing what he calls the 5 fundamental truths about trading. Internalizing these 5 truths is like a software update for your brain. The first truth: anything can happen. Literally anything. A news event can drop, a major bank can make a move, you have zero control over the market. Accepting this intellectually is easy. Believing it in your bones when your money is on the line is the real challenge. The second truth: you don't need to know what is going to happen next to make money. This shatters the illusion that trading is about prediction. It's not. It's about having a system with a positive expectancy, a statistical edge, and executing it over and over. Just like the casino. The third truth is that there is a random distribution between wins and losses for any given set of variables that define an edge. This means you could have a strategy that wins 60% of the time, but you could still experience a string of 7, 8, even 10 losses in a row. That's just statistics. The amateur trader sees that losing streak and declares their strategy broken. The professional who understands this truth sees it as a normal, expected part of the process and continues to execute. The fourth truth: an edge is nothing more than an indication of a higher probability of one thing happening over another. That's it. It's not a guarantee. It's a slight tilt in your favor. Your job isn't to be right. It's to let that edge play out over a large sample size of trades. And the fifth and perhaps most crucial truth: every moment in the market is unique. This one is powerful. Our brains are pattern matching machines. If we see a setup that looks just like one that made us a lot of money yesterday, our brain screams, this is a sure thing. But Douglas reminds us that even if it looks identical, the underlying forces, the buyers and sellers creating that pattern, are different. The context is different. Therefore, the outcome is not guaranteed to be the same. Every single trade is a unique event with a probabilistic outcome. When you truly absorb these truths, something magical happens. The market loses its power to make you feel angry, fearful, or euphoric. A losing trade is no longer a personal failure. It's simply the other side of your probability equation playing out. It's a business expense. A winning trade isn't a reason to feel like a genius. It's just your edge manifesting on this particular instance. You become detached, objective, and ruthlessly consistent. Douglas then dives deep into the specific psychological roadblocks, like the 4 primary trading fears. The fear of being wrong, which causes us to let losing trades run, hoping they'll come back, because we can't stomach the ego blow of admitting a mistake. The fear of losing money, which can make us so risk-averse that we cut winning trades short at the first sign of profit, just to lock in a small gain. The fear of leaving money on the table, which prompts us to chase trades after the ideal entry is long gone. And of course the big one, the fear of missing out or FOMO, which is responsible for more bad decisions than almost any other emotion. Trading in the zone gives you a concrete mental framework for neutralizing these fears. It's not about suppressing them. It's about redefining your relationship with the market, so these fears no longer get triggered in the first place. You move from a fear-based perspective to a curiosity-based one. Instead of "I hope this works," you start thinking, "I have a statistical edge. Let's see how this one plays out." The shift is profound. For any new trader in the US, this book is non-negotiable. Our culture often emphasizes being right, winning, and achieving success quickly. This can create immense internal pressure when you start trading. You feel like every trade is a reflection of your intelligence and worth. Mark Douglas completely deconstructs that. He shows you that successful trading has almost nothing to do with being smart, and everything to do with being disciplined. It's about creating a set of rules and having the mental fortitude to follow them, regardless of how you feel in the moment. Reading this book is like sitting down with a therapist who is also a master trader. It exposes the cognitive biases and emotional baggage you didn't even know you were bringing to the charts. It's uncomfortable at times, because it forces you to look in the mirror and take absolute responsibility for your results. You can no longer blame the market, your broker, or that guru on social media. Your results are a direct reflection of your mindset and your ability to execute consistently. So, after you've learned to read the language of the market, this book teaches you to achieve the mindset of a professional. Once you have the mindset of a casino, you understand that your edge only works over the long run if you can survive the short-term randomness. You need to stay in the game. And staying in the game isn't about picking winners. It's about managing losers. It's about bulletproofing your capital so that one bad hand, or even 10 bad hands, can't take you out. And that brings us to The Science of Survival, The Mathematics of Risk, and our next essential book. And the book that provides this science, this mathematical foundation for survival, might just be one of the most important, and admittedly, one of the most challenging books a new trader will ever encounter. It's called The Mathematics of Money Management by Ralph Vince. Now I know what you're thinking. Mathematics? I got into trading to make money, not to go back to algebra class. And I hear you. This isn't a beach read. There are formulas. There are charts that look like a seismograph reading during an earthquake. But hidden within those pages is the code, the very source code, that separates professional traders from the 90% who fail. It's the difference between treating the market like a casino and treating it like a business. Let's picture a common scenario for a new US trader. Let's call her Sarah. Sarah has spent months developing a trading strategy for the euro to US dollar pair. She's backtested it, she's demo traded it, and it works. It has a positive expectancy. Let's say it wins 60% of the time, and her average winning trade is slightly larger than her average losing trade. By all accounts, she should be making money. So she funds her account with a few $1,000s and starts trading live. The first week is incredible. She hits a string of winners and her account is up 15%. She feels like a genius. She thinks, this is easy. I should be risking more to make more. So she doubles her position size. The next trade is a loser. It stings, wiping out a good chunk of her gains. A little shaken, she cuts her position size in half for the next trade, trying to be safe. That one, of course, is a winner, but it's so small it barely moves the needle. Frustrated, she sees another setup she loves and decides to go big to make it all back. That trade also loses. Within a month, despite having a winning strategy, Sarah's account is down 40%, and her confidence is completely shattered. What went wrong? It wasn't her strategy. It wasn't her ability to read a chart. It was her money management, or more accurately, her complete lack of a mathematical framework for it. She was sizing her positions based on emotion. Greed after a win, fear after a loss. Ralph Vince's book is the antidote to that poison. It surgically removes emotion from the most critical decision you make as a trader. Not what to buy or sell, but how much to risk on that decision. The central groundbreaking concept Vince introduces is something called optimal F, where F stands for fraction. It's a formula that helps a trader determine the optimal fraction of their capital to risk on any single trade to maximize the geometric, or long-term, growth of their account. This is a revolutionary idea for most new traders. We're taught to think in a straight line. More risk equals more reward. Vince proves mathematically that this is dangerously false. Think of it like this. Imagine you're a professional drag racer. Your goal is to get to the end of the quarter mile as fast as possible. A novice thinks the answer is just to slam the gas pedal to the floor instantly. What happens? The tires spin out, you lose traction, and you either go nowhere fast or you fishtail into the wall. A professional driver knows the exact amount of throttle to apply to get the optimal amount of traction and acceleration, feathering the pedal to maximize speed over the entire course. Optimal F is the formula for feathering the gas pedal on your trading account. Risking too little, and your account grows at a snail's pace. But risk too much, just a little bit past that optimal point, and your returns don't just flatten, they fall off a cliff, and your risk of total account blow up, what traders call the risk of ruin, skyrockets towards certainty. Vince's book shows with terrifying clarity that you can have a strategy that wins 70% of the time, but if you risk too much on each trade, you will go broke. It's not a possibility, it's a mathematical inevitability. This is because of the brutal asymmetry of losses. If you lose 50% of your account, you don't need a 50% gain to get back to even. You need a 100% gain, which is twice as hard to achieve. Vince's work forces you to confront this reality. He shows you the precipice. He walks you right up to the edge of the canyon of financial ruin and says, "Here. This is the line." The math says do not cross it. For a US Forex trader, this is profoundly important because of one word: leverage. Leverage is what allows you to control a large position with a small amount of capital. It's a magnificent tool. It's also the reason most Forex traders fail. They see 100-to-1 leverage and think it's a way to get rich quick. They use it to put on massive positions relative to their account size, flying way past their optimal F without even knowing it exists. They are, in effect, slamming the gas pedal to the floor in a top fuel dragster with no training, no helmet, and no seatbelt. The result is predictable and catastrophic. The mathematics of money management is the engineering manual for that engine. It teaches you that leverage isn't a get-rich-quick tool. It's a precision instrument for applying a mathematically determined amount of risk, and no more. Reading this book changes your entire perspective. You stop asking, "How much can I make on this trade?" And you start asking, "What is the optimal amount to risk on this trade to ensure my long-term survival and growth?" You stop thinking about individual trades and start thinking about your entire trading career as a statistical endeavor. The book dives deeper into concepts like the geometric mean, which is the true measure of your system's performance over time, far more important than the simple arithmetic average. It teaches you how to analyze and prepare for drawdowns, the inevitable periods of losses, so that they are just a calculated cost of doing business, not a career-ending event. This book is your transition from amateur to professional. It's the moment you stop being a gambler playing a hunch and start being the house meticulously calculating the odds. It's not about finding a magic formula that will make every trade a winner. Such a thing doesn't exist. It's about creating a mathematical fortress around your capital. It's about designing a system so robust that it can withstand a barrage of losing trades and still come out stronger on the other side. It's about knowing with mathematical certainty that as long as you stick to your risk model, you will survive to trade another day. The emotional swings of winning and losing fade into the background, replaced by the quiet confidence of methodical execution. So you have the bulletproof mindset from our previous books, and now, with Vince's work, you have the mathematical risk model, the armor plating for your account. You understand the psychology, and you understand the probability. But there's a missing piece to the puzzle, isn't there? What are you actually applying this risk model to? What is the system itself? What signal on a chart tells you to buy the euro or sell the Japanese yen in the first place? It's about moving from theory to execution, from a blueprint to a skyscraper. And the next book on our list is The Ultimate Architect's Guide to Building That Skyscraper, One Solid, Well-Defined Brick at a Time. That guide is The New Trading for a Living by Dr. Alexander Elder. If the books we've discussed so far gave you the raw materials, the lumber, the steel, the concrete of market knowledge, this book is the master blueprint that shows you how to put it all together. Dr. Elder, a psychiatrist turned professional trader, understood something profound. A trader's biggest enemy isn't the market, it's themselves. And his entire philosophy is built around a simple, powerful, and unforgettable framework: the 3 M's. Mind, method, and money management. Let's break that down, because this framework is arguably one of the most important concepts you will ever encounter in your trading journey. First, there's mind. This is the psychology of trading. Elder argues correctly that you can have the most brilliant trading system in the world, but if your mind isn't right, you will lose. Think about it. How many times have you heard of someone revenge trading after a loss, trying to win it back from the market? Or getting greedy on a winning trade, holding on way too long hoping for a home run, only to watch it reverse and turn into a loss? That's not a strategy problem. That's a psychology problem. That's a failure of the first M. Dr. Elder was a psychiatrist. He understood the human mind's pitfalls, our tendency toward fear, greed, hope, and regret. He teaches you to approach the market not as a gambler in a Las Vegas casino, but as the owner of a small business. Your trading account is your inventory. Your trading plan is your business plan. Every trade is a calculated business decision, not an emotional bet. He forces you to confront the reality that the market doesn't owe you anything. It doesn't know you exist. The only thing you can control is yourself, your entries, your exits, and most importantly, your emotional reactions. This shift in perspective from gambler to business owner is a game changer. It's the mental foundation upon which any sustainable trading career must be built. Without it, you're just building on sand. The second M is method. This is your system for finding and executing trades. This is where the technical analysis we talked about earlier comes into play. But Elder's genius is that he doesn't just throw 100 different indicators at you. He teaches you how to think systematically. He introduces concepts like his famous triple-screen trading system, which is a brilliant way to analyze a currency pair on multiple timeframes to align yourself with the dominant trend. It's designed to filter out the noise and prevent you from fighting the market's main current. Think of it like this: knowing what a moving average is like knowing what a hammer is. Knowing what the RSI indicator is like knowing what a saw is. But knowing how to use them together in a specific sequence to build a sturdy chair, that's a method. That's what Elder provides. He gives you a framework for creating your own method, tailored to your own risk tolerance and personality. He's not saying use this exact system. He's saying, here is how a professional system is constructed. Here are the components. Now go build one that works for you. He empowers you to become the architect of your own trading strategy, rather than just blindly following someone else's signals. This part of the book takes the theoretical knowledge from other texts and makes it ruthlessly practical. But it's the third M that separates the amateurs who blow up their accounts from the professionals who stay in the game for decades. And that is money management. This is the single most critical pillar of the three. You could have mediocre psychology and a mediocre method, but with excellent money management you can still survive. But if you have brilliant psychology and the best method in the world with terrible money management, your failure is not a matter of if, but when. It's in mathematical certainty. Dr. Elder is famous for popularizing what's known as the 2% rule and the 6% rule. The concept is devastatingly simple. The 2% rule suggests that you should never risk more than 2% of your total account equity on any single trade. If you have a $10,000 account, the absolute most you can lose on one trade is $200. Period. No exceptions. This isn't a suggestion. It's a law for survival. Why is this so powerful? Because it takes the emotion out of losing. Losing is a part of trading. Even the best traders in the world lose 40 to 50% of the time. The 2% rule ensures that no single loss can ever cripple you. You can be wrong 5 times in a row and have only lost 10% of your capital. You're still in the game, mentally intact, ready for the next opportunity. Now imagine a new trader who risks 20% of their account on one sure thing. They lose. Now they're down 20%. They need to make 25% on their remaining capital just to get back to even. The math is already working against them. After another loss, they're in a catastrophic hole. The 2% rule prevents that from ever happening. The 6% rule is its partner. It suggests that if your total open risk across all your trades plus the losses for the current month reach 6% of your account equity, you stop trading for the rest of the month. You close all positions and you step away. This is your circuit breaker. It prevents a bad week from turning into a disastrous, account-destroying month. It forces you to take a break, reevaluate your strategy, and analyze what's going wrong, instead of spiraling into a revenge trading frenzy. It's the ultimate defense mechanism. Dr. Elder uses the perfect analogy to tie this all together. A 3-legged stool. A stool needs all 3 legs to be stable. If you take away the mind leg, if you're an emotional wreck, the stool collapses. If you take away the method leg, if you have no system for finding trades, the stool collapses. And if you take away the money management leg, if you risk too much, the stool collapses, and it collapses the fastest and most violently of all. This book is essential because it's a holistic system. It's the first book many new traders read that makes them realize trading isn't about finding a magic indicator or a secret pattern. It's a professional endeavor that requires discipline, a systematic approach, and an unwavering, almost religious-like commitment to capital preservation. It transforms you from a chart gazer into a risk manager. And in the world of Forex, the best traders aren't the best predictors. They are the best risk managers. The new Trading for a Living is your operations manual for becoming exactly that. Elder gives us the complete architectural plan, mind, method, and money. He builds the structure. But what about the unseen forces that can knock that structure down? The psychological earthquakes and emotional hurricanes that even the best plans can't account for? Our next book isn't about the plan. It's about the person executing the plan. It's about rewiring your brain to think in probabilities, and it's considered by many to be the single most important book a trader will ever read. That book is Trading in the Zone by Mark Douglas. And if books on technical analysis are the blueprints for building a trading system, this book is the psychological operating manual for the person who has to run it. It's a book that doesn't teach you a single thing about where to place a stop loss or what a moving average crossover means. Instead, it addresses the single greatest obstacle to consistent profitability. Mark Douglas starts with a premise that every struggling trader knows in their gut to be true. You can have a profitable, back-tested, statistically proven trading strategy and still lose money. Why? Because there's a massive, painful gap between what you know you should do and what you actually do when real money is on the line. Have you ever seen a perfect trade setup according to your plan, but hesitated? You got scared, you waited for more confirmation, and then you watched in agony as the trade took off without you hitting the exact profit target you had planned. Or worse, have you ever been in a winning trade, but closed it out for a tiny profit because you were terrified of it turning into a loser, only to watch it run for hundreds more pips? Have you ever taken a loss, felt that sting of anger and frustration, and immediately jumped back into the market to make it back, throwing your rules out the window? If you answered yes to any of these, you've experienced the psychological pitfalls that Douglas argues are the primary reason 90% of traders fail. It's not about a lack of knowledge. It's a lack of mental discipline. The core issue, he explains, is that we are hardwired with beliefs and emotional responses that are fantastic for navigating everyday life, but are absolutely catastrophic in the trading arena. The entire book is built around one central paradigm-shifting concept. You must learn to think in probabilities. This sounds simple, but it is profoundly difficult to internalize. In our daily lives, we seek certainty. We want to be right. Our ego is tied to being correct. In school, you get an A for being right. At work, you get a promotion for being right. Being wrong feels bad, it feels like failure. But in the market, the need to be right is a death sentence for your account. The market is a stream of probabilities, not certainties. A perfect A+ trade setup can still fail. A sloppy, questionable setup can sometimes work out. The outcome of any single, individual trade is essentially random. This is where Douglas introduces the brilliant analogy of the casino. Think about it. A casino doesn't know whether the next spin of the roulette will be red or black. It doesn't know if the next hand of blackjack will be a winner or a loser for the house. The outcome of any single event is uncertain and unpredictable. So how do casinos build billion-dollar empires in the desert? They have an edge. A small statistical advantage that plays out over a large sample size of events. They know that over thousands of spins and hands, their slight edge in the odds will mathematically ensure their profitability. The casino operators don't get emotional about a single jackpot. They don't celebrate a player losing $1,000, and they don't panic when a player wins $50,000. They are completely detached from the outcome of any individual event because they are focused entirely on the process and their statistical edge. They are thinking in probabilities. Trading in the Zone is your training manual for becoming the casino, not the gambler. It's about cultivating a mindset where you truly, deeply accept the uncertainty of each trade. It's about executing your edge, your system, flawlessly over and over again, regardless of the outcome of the last trade or the last 5 trades. To achieve this, Douglas presents what he calls the 5 fundamental truths about trading. Internalizing these 5 truths is the key to unlocking the zone. First, anything can happen. Anything. No matter how certain you are, no matter what the news says, no matter how perfect the chart pattern looks, the market can do the complete opposite. This isn't a negative thought. It's a reality that, once accepted, forces you to manage risk on every single trade. It's why you use a stop loss. Not because you think you'll be wrong, but because you accept that anything can happen. Second, you don't need to know what is going to happen next to make money. This directly combats the need to predict the market. Your job isn't to be a fortune teller. Your job is simply to find a pattern or a condition that has a higher probability of moving in one direction than the other, and then to execute a trade based on that edge. Just like the casino, you don't need to know the next outcome. You just need to know that your edge will work out over time. Third, there is a random distribution between wins and losses for any given set of variables that define an edge. This is a huge one. Let's say your system has a 60% win rate. You know that over 100 trades you should win about 60 of them, but you have no idea what the sequence of those wins and losses will be. You could have 10 losses in a row, followed by 15 wins. You could win 1, lose 1, win 2, lose 3. It's random. If you truly believe this, you won't get overconfident after a winning streak or devastated after a losing streak. It's all just part of the distribution of your edge. Fourth, an edge is nothing more than an indication of a higher probability of one thing happening over another. This demystifies your trading system. Your strategy isn't a magic money machine. It's just a tool for identifying moments where the odds are slightly in your favor. That's it. It removes the pressure of needing every trade to be a home run. And the fifth truth: every moment in the market is unique. This is critical for preventing past experiences from tainting your present actions. The last time you traded the euro to US dollar and it shot up, it doesn't mean the exact same setup today will do the same thing. Each moment is a fresh, unique event with its own outcome. This stops you from hesitating on a new trade because the last one was a loser, or from getting reckless on a new trade because the last one was a winner. By drilling these 5 truths into your mind, you begin to neutralize the emotional threats of fear, greed, and ego. You start to see the market not as a personal adversary that's out to get you, but as a neutral flow of information and opportunity. You stop taking losses personally. A loss is no longer a reflection of your intelligence or your worth. It's simply a business expense, a necessary part of a probabilistic model. This is what it means to be in the zone. It's not a state of euphoria. It's a state of objective, calm, and confident execution. It's when you see a setup that meets your criteria, and you act without hesitation. You place the trade, you set your stop, you define your target, and you let the market do what it's going to do. You are unattached to the outcome because you know that your real work is the consistent application of your edge over a large series of trades. For a new US trader, this book is arguably more important than any book on candlestick patterns or indicators. It will save you from the emotional roller coaster that blows up most new accounts. It will give you the mental framework to survive the inevitable losing streaks and to properly manage the winning ones. It teaches you that the holy grail of trading isn't a secret indicator. It's a state of mind. Once your mind is calibrated to think like a professional, the next critical step is to manage the lifeblood of your account, your capital. How do you define risk in a way that allows your probabilistic edge to play out over the long term, protecting you from those inevitable random strings of losses? Our next book isn't just about placing stop losses. It's a masterclass in the mathematics of survival and the art of position sizing. And that book is Trade Your Way to Financial Freedom by Dr. Van K. Tharp. Now, if you only take one thing away from this entire video series, let it be this. Tharp drops a bombshell on the very first few pages that completely rewires how you think about trading. He argues that a trader's success is determined by 3 things. Psychology, which he gives about a 30% weight. The system, meaning your entry and exit rules, he gives a tiny 10% weight. And the final 60%, the lion's share, the component that truly separates the winners from the losers, is position sizing. Think about that. 60%. Most new traders in the US and frankly around the world spend 99% of their time on the 10% factor. They're endlessly searching for the holy grail indicator, the perfect moving average crossover, the flawless chart pattern. They believe that if they can just predict the market's next move with a little more accuracy, they'll finally be profitable. Tharp looks at that and says, you are fundamentally misunderstanding the game. You're focusing on the least important part of the equation. Let me paint a picture for you. Imagine 2 traders. Let's call them Alex and Ben. Alex has what he believes is a phenomenal trading system. He's backtested it, and it wins an incredible 80% of the time. Alex feels like he's found the secret code to the market. He feels invincible. On his first trade, he risks 5% of his account and wins. Fantastic. The next trade, he feels even more confident, so he risks 10%. It's another win. His account is soaring. He starts thinking about quitting his job. On the 5th trade in a row, a clear winner, he decides to go big. He risks 30% of his now much larger account on a sure thing. But this time, the market does something unexpected. A sudden news event, a random spike, it doesn't matter. The trade goes against him and he gets stopped out. In one single move, he loses almost a third of his capital, wiping out all his previous gains and then some. He's devastated, confused. How could his perfect system fail him so spectacularly? Now let's look at Ben. Ben's system is average. It only wins about 50% of the time. On paper, it looks far inferior to Alex's. But Ben has Red Van Tharp. He doesn't focus on his win rate. He focuses on two things Alex completely ignores: his risk-to-reward ratio and his position sizing. Ben's system ensures that his average winning trade is 3 times larger than his average losing trade. And most importantly, Ben has a golden rule. He never, ever risks more than 1% of his account equity on any single trade. Let's watch Ben trade. His first trade is a loss. He loses 1%. No big deal. His second trade is a win. He makes 3%. His third trade is a loss. Down 1%. Fourth trade, a loss. Down another 1%. Fifth trade is a win. 3%. After 5 trades with only 2 winners, Ben is actually up 4% in his account. Alex, after 5 trades with 4 winners, is down significantly and is emotionally shattered. Ben is calm, collected, and steadily growing his account. He understands that trading isn't about being right all the time. It's about surviving long enough for your mathematical edge to manifest. This is the power of what Tharp calls position sizing. He introduces a revolutionary concept called R multiples. It's simple, but it will change your life. R is your initial risk. If you buy the euro to US dollar at 1.0850 and place your stop loss at 1.0800, and you size your position so that if you get stopped out, you lose exactly $500, then your initial risk, or 1R, is $500. From now on, you stop thinking in dollars, pips, or percentages. You think in R. If you lose on that trade, you had a -1R result. If the trade goes your way and you take profit at 1.0950, you've made twice your risk, so that's a +2R winner. If it goes to 1.1000, that's a +3R winner. This framework does something magical to your psychology. It detaches you from the money. It turns trading into a game of probabilities and risk management, not a gut-wrenching emotional roller coaster. You're no longer saying, "I just lost $500. You're saying, "The result of that trade was -1R. It was within my expected parameters." Next trade. You become a casino manager, not a gambler. The casino doesn't fret over a single loss at the blackjack table. They know that over thousands of hands, their small statistical edge will guarantee the house wins. Your trading system's positive expectancy, the average R multiple you can expect over many trades, is your edge. Position sizing is the set of rules that guarantees you can stay in the game long enough to let that edge pay out. Risking 1% per trade, as Ben did, means you could endure a string of 20, 30, even 40 losing trades in a row and still be in the game, waiting for the winners that you know are statistically due. Alex, with his reckless position sizing, couldn't even survive 1 loss after a string of wins. This book forces you to confront the single most important question a trader can ask. How much should I risk on this trade? The answer isn't a gut feeling. It's a mathematical calculation based on your system's performance and your personal risk tolerance. Tharp walks you through different models like the fixed fractional model to help you determine the optimal percentage to risk to maximize growth while minimizing your risk of ruin. For the new US trader, bombarded with social media hype about huge, leveraged bets, this book is the antidote. It's the sober, rational voice of a seasoned professional teaching you how to build a trading career like a business. It's not about finding one miraculous trade that will make you rich. It's about designing a system and a risk model that can generate consistent returns over hundreds, even thousands of trades. It's about longevity. It's about survival. So we've now built a powerful foundation. We understand how to read the market's intentions through its structure and price action. We've worked on mastering our own internal psychology to execute flawlessly. And now, with Tharp's wisdom, we have a mathematical framework to manage our capital like a professional fund manager. We have the micro level sorted. But what about the macro? What about the giant global forces that cause currency pairs to trend for months or even years at a time? We've learned to manage risk on a trade-by-trade basis. But how do the pros position themselves for the macro-level tidal waves, the tectonic shifts in the global economy that can define a trading career? The answer lies in understanding the narrative of money itself. And our next book is the Rosetta Stone for deciphering it. And that book is Neil Ferguson's The Ascent of Money, A Financial History of the World. Now hold on. I know what you're thinking. A history book? I'm here to learn how to trade the euro/dollar. Not to get a lecture on 14th century Italian banking. But that's precisely where most new traders get it wrong. They see the Forex market as a video game, a series of abstract numbers and squiggly lines on a screen. They fail to realize that every single tick, every pip of movement, is the culmination of a 700-year-old story. A story of power, of innovation, of human greed and fear. And if you don't know the plot, you're just a background character getting tossed around by forces you can't even see. The Ascent of Money isn't a trading manual. It's a map of the financial DNA that codes the modern world. Ferguson takes you on a journey, showing you that the concepts we grapple with every day, debt, credit, bonds, stocks, insurance, aren't modern inventions. They are ancient technologies, refined over centuries in the crucible of war, revolution, and human ambition. For a U.S. trader, this isn't just trivia. It's foundational. Why is the U.S. dollar the world's reserve currency? The answer doesn't start in 1944 at Bretton Woods. It starts in Renaissance Florence with the Medici family. Ferguson brilliantly illustrates how the Medici, a family of doctors turned wool merchants, revolutionized the world not with swords, but with ledgers. They perfected double-entry bookkeeping and created a vast network of international banking. They figured out how to turn risk into a tradable commodity. When you look at the U.S. Federal Reserve debating interest rates, you are watching a modern-day reenactment of the same fundamental struggle the Medici faced. How to manage the flow of credit to fuel growth without creating catastrophic bubbles. The debt that powers the American economy, the very debt that influences the Fed's every move, and thus the dollar's value, has its roots in the Florentine florin. Understanding this history gives you a profound context for why central bank policy is what it is. Then the book transports you to the Napoleonic Wars and the story of the Rothschild family. This chapter alone is worth the price of admission. We've all heard the myth of Nathan Rothschild at the Battle of Waterloo, using his network of carrier pigeons to get the news of Napoleon's defeat before anyone else, crashing the London bond market by selling, and then secretly buying it all back for pennies on the dollar. While the historical details are debated, the lesson is timeless and brutally relevant for a Forex trader. The bond market, the market for government debt, is the bedrock of the entire financial system. For a U.S. trader, the story of the Rothschilds is the story of U.S. Treasuries. When you see news about a U.S. bond auction, or you hear analysts talking about the yield curve, they are talking about the modern equivalent of Rothschild's battlefield. The demand for U.S. government debt is a direct measure of global faith in the United States. A strong bond auction can strengthen the dollar. A weak one can send it tumbling. Ferguson teaches you that the bond market isn't a boring, abstract concept. It's the ultimate vote of confidence in a nation's future, and its price is driven by information, sentiment, and fear, the exact same things that drive the Forex market. But what happens when confidence morphs into delusion? Ferguson walks us through one of the most insane stories in financial history: John Law and the Mississippi Bubble in 18th century France. Law, a Scottish economist and convicted murderer, convinced the French government to let him create the first central bank and issue paper money backed not by gold, but by the theoretical future profits from French territories in North America, specifically Louisiana. The public went wild. Shares in his Mississippi company skyrocketed, creating millionaires overnight from a population that had never even seen a stock before. The mania was so intense that the French word for millionaire was coined during this period. And then, inevitably, it all came crashing down, wiping out fortunes and plunging the French economy into chaos. As a Forex trader, this story is a masterclass in market psychology. It's the historical blueprint for every bubble since, from the dot-com bust of 2000 to the housing crisis of 2008. When you see a currency pair going parabolic, when you see a risk-on environment where traders are piling into speculative assets like the Australian dollar or the New Zealand dollar and dumping safe havens like the Japanese yen or Swiss franc, you are witnessing the ghost of the Mississippi Bubble. Ferguson's account immunizes you against the siren song of irrational exuberance. It teaches you to ask the hard questions. Is this price movement based on real economic value? Or is it just a story people want to believe? Understanding this historical pattern helps you recognize the difference between a healthy trend and a manic bubble about to pop. Finally, and perhaps most critically for the 21st century U.S. trader, Ferguson introduces the concept of chimerica. This is his term for the symbiotic and deeply intertwined economic relationship between China and America. For decades, China acted as the world's factory, producing cheap goods and saving the US dollars it earned. It then lent that money back to the United States by buying US Treasury bonds, which helped keep American interest rates low and allowed US consumers to keep buying more Chinese goods. It was a massive global feedback loop. Reading this section is like having the last 10 years of geopolitical headlines suddenly click into place. The trade wars, the debates over supply chains, the tension over technology, it's all a consequence of this Chimerica relationship fraying at the edges. For a Forex trader, this isn't just an interesting geopolitical theory. It is the single most important macroeconomic narrative of our time. It dictates the flow of capital around the globe. When tensions between the US and China rise, where does money flow? It flows to perceived safety, often strengthening the US dollar and the Japanese yen. When relations thaw, you might see capital flow back into emerging markets and commodity currencies. Understanding Chimerica gives you a framework for analyzing news that would otherwise seem random and disconnected. It helps you see the grand chess match being played where currencies are the pawns. By the time you finish The Ascent of Money, your perspective on the markets will be fundamentally altered. You'll no longer see the dollar, the euro, or the yen as just symbols on a screen. You'll see them as characters in a long and dramatic story. You'll understand that the Federal Reserve isn't just reacting to last month's inflation data. It's operating within a system of debt and credit that was born in medieval Italy. You'll understand that a sell-off in US bonds isn't just a technical event. It's a global vote of no confidence with echoes of Waterloo. You will have moved beyond simply reacting to price and started to understand the forces that create price in the first place. This book provides the context, the deep historical soil from which a true, lasting understanding of the global markets can grow. But this grand historical perspective presents a new, and perhaps more intimidating challenge. If you are just one small trader standing in the path of these immense, centuries-old financial tides, how do you possibly manage your own actions? How do you control the one variable you actually have power over, yourself? After understanding the world, you must then understand your own mind, and that requires a completely different kind of map. This new map isn't of the world or of the markets. It's a map of your own internal landscape. Because the greatest risk in trading isn't a sudden market crash or a surprise news event. The greatest risk, day in and day out, sits right between your ears. You can have the most sophisticated analytical models, the fastest data feeds, and a risk management plan written by a Nobel laureate, but if you can't control your own impulses, none of it matters. You will become your own worst enemy. This is the final frontier for every trader who moves beyond the beginner stage. It's the realization that the battle isn't you versus the market. It's you versus you. And to win that battle, you need a new set of tools, which brings us to the book that is, without exaggeration, the Bible of trading psychology. Trading in the Zone by Mark Douglas. If the previous books we discussed were about learning the rules of the game, this book is about learning how to play it without letting your emotions burn down the entire stadium. Douglas's central argument is revolutionary for most new traders. Your analytical skills are not the key to consistent profitability. The key is your mindset. He argues that most of us are hardwired to think in ways that are completely counterproductive in the market environment. In our daily lives, we're taught that more effort equals better results, that being right is good, and that uncertainty is something to be feared and eliminated. In the markets, these beliefs are poison. Douglas introduces traders to a new way of thinking, a probabilistic mindset. He wants you to stop thinking about any single trade in terms of right or wrong, win or lose. Instead, he teaches you to see each trade as just one instance in a long series of probabilities. It's like a casino. The casino owner doesn't fret over a single gambler hitting a jackpot on a slot machine. Why? Because he knows that over thousands of pulls, the house's statistical edge will always play out. The outcome of any single pull is random and irrelevant. The casino operates in the zone. Trading in the zone is your guide to becoming the casino, not the gambler. The book drills down on the core psychological hurdles: fear of being wrong, fear of losing money, fear of missing out, and greed. Let's take a common scenario. A new trader, let's call him Alex, has a solid strategy. His backtesting shows that it's profitable 60% of the time. He enters a trade based on his rules. The market immediately moves against him. Panic sets in. The fear of being wrong, of taking a loss, becomes overwhelming. He closes the trade early, taking a small loss, just to be safe. A few hours later, the market turns around and blasts right through his original profit target. He followed his fear, not his system. Later, he sees a trade that's already skyrocketing. Fear of missing out kicks in. He jumps in late at the very top, abandoning his rules. The market immediately reverses and he takes a massive loss. Douglas explains that Alex's problem isn't his strategy, it's his beliefs. He hasn't truly accepted the reality of the market, that it is inherently uncertain, and that losses are an unavoidable part of the business. He's still trying to predict and control an uncontrollable environment. The book provides a framework, including what Douglas calls the 5 fundamental truths, to rewire your brain. It teaches you to truly, deeply accept that anything can happen, that you don't need to know what's going to happen next to make money, and that your trading edge is simply a higher probability of one thing happening over another. Once you internalize this, the book is filled with powerful tools like this: visualization exercises to rehearse success, techniques for setting process-oriented goals instead of outcome-oriented ones, and methods for conducting productive weekly reviews of your mental performance. It reframes trading away from a get-rich-quick scheme and into a serious, professional endeavor focused on continuous self-improvement. Reading one of its short lessons each morning can be a powerful ritual to get your mind in the right state before the market even opens. Together, these 2 books form an unbreakable shield for your trading capital and your sanity. Trading in the Zone is the strategic blueprint for your mind. It gives you the paradigm-shifting perspective needed to view the market without fear or greed. The Daily Trading Coach is the tactical field guide. It gives you the daily drills and habits to make that perspective your reality. Neglecting this side of your education is like a pilot learning everything about aerodynamics, but never practicing how to handle turbulence. When the storm hits, and in the Forex market it always does, it won't be your knowledge of chart patterns that saves you. It will be your ability to remain calm, follow your process, and fly the plane. We've now covered the grand macro strategy, the foundational technical analysis, and the critical internal mindset. We've built the engine and reinforced the cockpit. But how do you put it all together into a single cohesive vehicle? How do you combine market analysis, risk management, and psychology into a repeatable, systematic process that you can execute day in and day out? That final step, the synthesis of all these elements, is what we'll cover with our final, and perhaps most practical book of all. And so we arrive at the final piece of the puzzle, the book that serves as the master blueprint for building your entire trading operation. If the previous books were the individual college courses, economics, psychology, statistics, then this final book is the capstone project where you build a functioning business from everything you've learned. That book is The Art and Science of Technical Analysis, Market Structure, Price Action, and Trading Strategies by Adam Grimes. Now let me be perfectly clear. This book is not a light read. It's a dense, comprehensive, academic-level textbook on trading. It's the one you keep on your desk, not on your nightstand. But its value is precisely in its depth. While other books give you the pieces, Grimes shows you how to assemble the engine. He forces you to move beyond the vague, subjective world of, "that looks like a good setup," into the rigorous, evidence-based world of a professional market operator. The core premise that Grimes drills into you is that as a trader, you are a professional statistician. Your job is not to predict the future. Your job is to find patterns, what he calls edges, that have a positive statistical expectancy over a large series of trades. That's it. You are looking for situations where the odds are tilted even slightly in your favor, and then you are to exploit that edge with disciplined risk management over and over again. He demolishes the idea of chart art, where traders draw a million lines on a chart and hope for the best. Instead, he presents a framework for viewing the market through a lens of pure objectivity. He asks you to prove it. Does this pattern actually work? How often? What's the average win? What's the average loss? If you can't answer these questions with data from your own research, then you don't have an edge, you have a guess. To get you started, he outlines a handful of core patterns that are rooted in fundamental market psychology, the way markets trend, pull back, and reverse. He details specific setups like pullbacks in a strong trend, or failure tests at key support and resistance levels. But here's the critical difference. He doesn't just show you the pattern. He shows you how to define it with absolute precision. What constitutes a valid trend? How deep must a pullback be to be considered? Where exactly does the entry trigger? Where is the logical stop-loss placement based not on a random number of pips, but on the market structure itself? This is where the book transforms from theory into a practical guide. It's the ultimate how-to for building a concrete written trading plan. Imagine a pilot before takeoff. They don't just wing it. They go through a meticulous written checklist for every single flight. Grimes teaches you to build that checklist for your trading. Your trading plan based on his framework will have sections for every contingency. The entry checklist. Is the market in a clear trend? Has a valid pullback occurred to a specific zone? Has a specific candlestick pattern formed as a trigger? Check, check, check. No checks, no trade. It's that simple. It removes the emotion, the hesitation, the FOMO. You are no longer a gambler pulling a lever. You are a professional executing a predefined process. Then comes the trade management plan. If the trade moves in your favor, where do you take partial profits? Where do you move your stop loss to break even? These are not decisions you make in the heat of the moment, when greed and fear are screaming in your ear. These are decisions you made in the calm, rational environment of your weekend planning session, and you are now simply executing the plan. And most importantly, the exit plan for a losing trade. You know the exact point of invalidation before you ever click the mouse. The point where the market has proven your thesis wrong. The second it hits that price, you're out. No questions, no hope, no let me see if it comes back. The plan is the plan. But the most powerful part of the entire book is the emphasis on review and refinement. This is what separates the amateurs from the pros. Grimes advocates for a meticulous process of journaling every trade. Not just the entry and exit, but your psychological state, your reasoning for taking the trade, and what you could have done better. Your trading plan isn't a static document carved in stone. It's a living, breathing thing. You collect data on your own performance. You see which setups are working for you and which aren't. You make small, incremental adjustments based on data, not on a whim. You are building your own unique statistical model of the market, tailored to your own psychology and risk tolerance. So let's bring it all together. Let's look at the incredible journey these books create. You started with Jack Schwager's Market Wizards, which lit the fire. It showed you the sheer possibility and introduced you to the diverse mindsets of the world's greatest traders. It answered the question, is this possible? With a resounding yes, but also showed you it requires immense dedication. Then, you picked up John Murphy's Technical Analysis of the Financial Markets. This was your foundational textbook. It gave you the language of the market, support, resistance, trend lines, chart patterns. It taught you how to read a chart, the same way you'd learn to read a map before a long journey. With that knowledge, you moved to Van Tharp's Trade Your Way to Financial Freedom. This book was a paradigm shift. It took your focus off finding the perfect entry and placed it squarely on what actually matters: risk management, position sizing, and expectancy. It taught you that you could be wrong more than half the time and still be incredibly successful, as long as you managed your risk like a professional. Taught you how to survive. But survival isn't enough. You need to master the internal battlefield. So you dove into Mark Douglas's Trading in the Zone. This was the psychological boot camp. It rewired your brain to think in probabilities, to accept risk without fear, and to execute your system with unwavering discipline. It built the mental fortress required to withstand the emotional storms of the market. And finally, with your mind fortified, your risk defined, and your analytical tools sharpened, you arrived at Adam Grimes' The Art and Science of Technical Analysis. This was the final step, synthesis. It took all those disparate elements and guided you through the process of forging them into a single, cohesive, repeatable trading plan. Your personal business plan for attacking the markets. This isn't just a reading list. This is a curriculum for a self-directed education in professional speculation. This is your path from being a retail gambler, clicking buttons based on hope, to becoming a systematic operator, executing a statistically validated edge with discipline. The journey is not easy, and reading these books is just the first step. The real work begins when you close the final page and start applying these lessons. When you start building your plan, testing your system, journaling your trades, and reviewing your performance. It's a process of constant learning and refinement. But a house built on a weak foundation will always crumble. These books are the bedrock. They provide the solid, unshakable foundation of principles, strategies, and mindsets that have stood the test of time. They are the collective wisdom of those who have not only survived the markets, but have thrived in them. So pick one. Start there. Don't just read it, study it. Take notes. Argue with the author in the margins. Internalize the lessons. Then move to the next. Build your knowledge brick by brick. The markets aren't going anywhere. They will be here next week, next month, and next year, offering endless opportunities. The real question is, will you be prepared to seize them? Your preparation, your education starts right here.